pushing forward. Rahul, good morning. Thank you for joining us. Suddenly, FIs are selling India. If one looks at the last 40 days of trading data, the sell number is almost at 80,000 crore, one of the highest outflow patches we've seen in a long, long time. What has changed? I mean, India is still a fantastic story. High growth, decent valuations. Why are you folks selling?
Okay. I think the broad reason for selling, and I must say that, look, we've kept our India overweights at significantly high levels. We continue to like the story from 1, 2 year perspective, even more than that. All the good things are happening. But probably a reason why FIs are selling India is, look, the markets outperform significantly compared to other markets like China and rest of the other EMs. There is outflow from the EM funds because large part of the EM universe is not doing well. That explains some of the redemption which is flowing to India also. And probably one thing which in hindsight we'll get the analysis for, a lot of the money which came in last year was from the macro funds in October, November, December, because nobody knew which FI was getting. So it was largely macro funds. And as they get the sense that Fed is tapering, the peak of the liquidity is behind us, global liquidity is behind us, some of the money is going out.
So, do you see the trend extending itself in 2022?
Next 3 months can be choppy. 3 months will be choppy because look, the tapering is aggressive. Inflation data in the US is fairly high, a bit worrisome for the policymakers over there. So next 3 months can be choppy, but look, anybody who's got a 1 to 3 year time frame for the markets should look to buy on dips. And look, the stories just got better, and we continue to maintain the view that we're still in the early stage of the economic cycle. You look at how rupees held on over last 6 months compared to other EM currencies. The forex reserves are robust at $640 billion plus.
Genuine fear around tapering, Rahul, because every expert we've spoken to, they've said that look, it is taper. Let's not confuse taper with taper tantrum, because the situation is very different than last time when it was introduced. So, if the fear is something which is getting addressed, do you think the outflows into emerging markets and India could multiply? I'm spending some time with you on flows, Rahul, because you've got an understanding and you are an FI, so you are in the right position to tell us, because that frankly has been a big irritant. I mean, despite such a great India story, 80,000 crore of outflows in 36 trading sessions.
So you're right. This is what we tell our investors, that guys, it's not like what was in 13, 14. The fiscal deficits are much better. More importantly, the current account deficits are much lower, significantly lower than it was in 2013, 14. We've not seen misallocation. We've not seen significant inflows because in 13, 14, there was a 9 to 12 cycle. There was a 2003, 4 to 8 cycle. So there was a lot of these misallocation of capital which had happened in the economies in those periods. There was significant capital inflows in those times. So none of those things are over there. So see, there is some bit of an selling which is coming through, but one would not be too much worried on that. I think as long as the earnings delivery happens, again for bottom up investors, it gives good opportunity to add to the exposure.
Good morning, Rahul. So, you're saying we shouldn't be too worried about the sell-off that we have started to see, whether it's on Wall Street and, what we've seen early signs of in India as well. But something else that has happened, and when we talk about it, is inflation. Look at England, the highest inflation in 10 years, in the US, the highest in 39 years, and a depreciating rupee. How can one, play with that on the markets?
So obviously that is a kind of a key priority that's on mind of most policymakers, and that's where we've seen this monetary policy go from an extremely easy to a neutral or a tightening policy. But our view is this hyperinflation, which you're saying, is going to be transitory. A large part of this inflation is coming from this supply shocks, these bottlenecks which came through in Asia because of the spread of the Delta variant. But now with improved vaccination in the last 6 months, the governments would be a lot more open to keeping the economies away from lockdowns. So as that happens, some of the supply bottlenecks ease. The demand, which is running, let's say, 5 to 7% above 2019 levels, would also kind of normalize in coming 6 to 9 months. So I don't think we would be worried too much about this exceptionally high inflation in mid of 2020. Come March, we will see the peak of this inflation, and then it goes down towards the end of the year.
So then, going by what you're saying, would it not mean that if inflation is indeed transitory, and let's see how that pans out, that in the short to medium term, investors, markets need to accept that maybe the earning multiples that we've all gotten used to is not going to be the case? We saw that in the last quarter as well, earnings season in India, where margins had started to squeeze out in India Inc.
So here, what we're discussing is two things. See, multiple contraction is something I think we've discussed before on your channel also over last 6 9 months. In the second, third year of the recovery, as the money moves out of markets and goes in the real economy because of the pick of the economy, and the multiples contract from a market perspective. So that's happening, but that's kind of mitigated by the earnings follow through. The second point is the gross margin pressure and the EBITDA pressure, which we saw across most of the companies in last quarter earnings. Now, as these companies effect price increases, some of those gross margin pressures would be mitigated. And I think that coupled with the revenue momentum kind of a pickup should be positive from a medium term story.
So as we all go through the volatility, figure it out, wait for central bank action worldwide, is it once again going to be about, if I say the defensives, like the IT sector? Look at what Accenture has done. While Adobe might say that it's going to be very different, Accenture, which has a higher impact in India, and therefore once again, IT.
I think for next couple of months, probably makes sense to be a bit defensive. IT, hospitals, some of the staples can hold on. But look, one would use this opportunity to build exposure to the economic cyclicals also. So I think what's happened also is most FIs, including us, have been overweight banks, and as you've seen some bit of a selling come through, banks have more the bulk of the pain or the brunt of that, and which is why they've not kind of performed. But look, again, what happens is early part of the cycle is not bad for banks. They will see pickup in credit. They will see spreads improve. And as the NIs improve, I think from Feb, March, we should see banks also performing.
Right. Rahul, we were just looking at some of the recent global tech listings and the way they've actually fallen from their tops. I mean, a Robinhood, the fall from the peak is as large as 78%. Freshworks is down 51%. Bumble is down 60%. Grab, Didi, Coursera, Udemy, Remify, all of these have taken a massive knock. And, you know, somewhat similar is what's happening in India as well. I mean, all these fancied IPOs, because of the anchor investor window now opening, most of these, even, big listings are seeing massive corrections from their listing pops. Do you think 2022 will also be the year where there will be some valuation sanity? Because, you know, what we saw in the year gone by was, I mean, it almost reached a stage, why buy stocks? Just subscribe to an IPO and you'll double your money on the first day.
So you're absolutely right. I think you needed a couple of IPOs to open a bit lower for some bit of this sanity to come through. And in coming 3 to 6 months, as liquidity gets tight, as some of the anchor lock-ins get over, you will see valuations correct. So I think that's where one has to be a bit more judicious towards what businesses one wants to back from 3 to 4 years perspective. Look, there is always a high time opportunity for these businesses, but one's got to see the existing competitive intensity also. So we continue to like few spaces. I think health insurance is something where we participated. There's a huge headroom for growth. Food delivery is a space we've kind of participated in. We took small exposures in these names, mindful of the fact that these names can easily correct 30-40% over 6-9 months. And as and when that correction happens, one would be looking to add to that exposure. But one has to be very kind of careful when dabbling with the space, because local valuations can easily correct 30-40% in next 6 months.
Right. So, Rahul, besides this particular pocket, that's the newly listed / IPO universe, what is it that you're going to be wary of going forward or completely avoid perhaps?
So again, honestly, in India, we've not seen too many excesses. Look, industrials are a bit expensive. So if you look at a 5, 7 years history, they're a bit expensive, but you're getting signs of green shoots in terms of a manufacturing renaissance happening in the country. The PLI scheme has been a big trigger for this manufacturing renaissance. You've seen a shift of manufacturing away from China as the clients in US, Europe want to develop a manufacturing hedge because of all these COVID restrictions and US-China trade war, etc. So that's a positive tailwind for the sector. But look, the valuations are expensive. So if you see any issue on the demand front for the sector, there also you can see a correction.
Are banks suffering, Rahul, because of technical factors, which is overowned sector by FIs? They're selling what they own, which is banks, or there is a structural change, whether it is fintech or whether it is the lending cycle. What is the reason why banks are underperforming?
Okay, so Digaj, first, if you look at the lending cycle, look, we've just seen a NPA cleanup, and that cleanup process lasted for nearly 5 years or 6 years between 2014 to 2020. So we're still in the early stage of the cycle. You've not seen significant misallocation that one's got to be worried of. In terms of disruption for fintechs, I think Indian banks been preparing since 2016 on this competition from fintechs. So unlike in China where the SOE banks were a bit sleepy and we saw the likes of Tencent or Alibaba make significant inroads, I think the Indian banks are a lot more prepared, which is why we would be watchful of these new fintech names where valuations are expensive, but the incumbents are a lot more tech savvy, a lot more ready compared to the regional players. I think it's more an issue of over ownership. Most FIs love banks. This was a significant overweight. Banks are liquid. So what we see in FIs or hedge funds is if you want to do a bit of an country hedge, banks are the best proxy for that. So I think that's where banks are suffering. But like the way I said, once we see kind of the peak of this liquidity withdrawal or tapering, which should happen by Jan-Feb, once we see improving NI, interest should come back in banks.
So you are indicating that banks will be in overweight position and you don't think the current leg of underperformance is a worry for you?
Not at all. In fact, look, banks have been an overweight for us, and we continue to maintain our overweight in banks. Again, we continue to like the insurance space also, which is corrected in last 6 months. So financials continue to be close to about 40% of our portfolio.
From 1st of Jan 2021 to 31st, let's say 15th of December 2021, 12 months, how has the shape of your portfolio changed? Where have you added more? Where have you taken some chips off the table? And how are you positioning it for 2022, which is different from 1st of January 2021?
Okay, that's an interesting question. So if you look at early 21, look, we had banks exposure which was probably 5 to 7% lower, so that's moved up a bit. Our industrial exposure was a bit lower, again same 3 to 4%. That's kind of an moved up a bit. The portfolio has seen allocation of about 4 to 5% in these new IPOs. So we've been fairly disciplined about the companies we want to back. So we're watchful of the high valuations these names have. So you want to control the risk from the valuation de-ratings for these IPOs. And where we've taken money is we've taken money out of some pharma companies which look fairly full or rich in terms of valuations. There were no kind of growth triggers for these companies. We took some money off the consumer staples, where our view was that they will suffer through a margin pressure and a slower growth.
Interesting. Just looking at the market's texture, it really seems to be IT all the way. Rahul, we were just, and I know you alluded to this point earlier as well to my colleague's question, but we were just looking at the way Accenture's commentary has been yesterday when they declared their earnings. What does it really spell for IT? Because you know that in this post-COVID digitization era, IT services or Indian IT services are going to continue to be in the limelight. But the traditional IT companies, your TCSs, Infosys already, I mean, you could debate about the valuations already being ripe and a great run-up from the 2020 lows, but it seems like they're good to go for more.
So I think what we're seeing is a big flush out of budgets, which is happening. If you look at the commentary across most companies, including Accenture, people are not talking about large deals or big deals. That was something which was happening 6 months back. But these are a lot of these smaller projects, and like the way you rightly said, I think most of the Fortune 500 companies now realize that omni-channel big data analytics is the way to stay relevant for the next decade, and which is why this is a big priority spend for most companies, and Indian companies are benefiting because of that. So there's a bit of a flush out, and look, the sector in light of dollar strength, in light of whatever is happening globally in terms of a bit of risk off, can continue to hold on well for next 6 to 9 months.
Right. Rahul, I don't know if it's a fair question to ask you or not, but I'm really curious to know. 2021 has also seen the emergence of this new asset class, which is the digital realm, right? Everything from digital currencies to NFTs to what have you, metaverse now. Wanted to understand, as an investor, do you now need to have at least a tiny weeny bit of your portfolio invested into some digital asset?
Okay, I think I'm a bit too old for that. You need to get a 15 or a 20-year-old who can look at this and kind of give you a perspective on that. Look, this is all a function of easy liquidity. And you look at people have talked about Bitcoin as a replacement for gold, but to me it behaves like a growth stock. It behaves like a mid cap or a small cap stock. Whenever there's a risk on, that moves even faster. But look, whenever there's a global risk off, the correction is similar to a high beta name. So I think there is a bit of an esoteric stuff which is going on. What you see here when we kind of talk around is it's a bit of a speculation where people are allocating 1 or 2% of their net worth to it and willing to lose that in pursuit of a 5-7 bag again. But look, what we need to see is a stronger regulatory action so that a lot of people don't lose a significant amount of their savings in this. But look, I'm not a believer in it, so time would tell.
So Rahul, finally, two scenarios. On a 15-20% uptick, where would you be a seller? Similarly, on a 10-15% decline or a 15-20% decline, you will be a buyer or you will add more to your positions.
Okay. So let's say a 10-15% uptick, one would move money from IT because these companies would run into much higher base, much tougher comms by mid of 2020, and take that money to financials, take that money to again some of the domestic economy plays like autos, etc.
All right. Rahul, really appreciate your time. So glad you could join us. You've been very kind with your time. You've always accommodated our interview requests. So hope to see much more of you going forward in 2022 as well. On behalf from everyone from ET Now, have a wonderful year ahead.
Thanks for having me.